regulation, as well as its counterparty exposures, so that we are never again forced to make the choice between bailing out an institution or creating real and lasting harm to our financial system. The FDIC also sits on the newly established Financial Stability Oversight Council, or FSOC, whose task is to identify and address macro risk and coordinate the regulation of systemically important institutions. This group must be ever vigilant in monitoring emerging risks, and regulators must have the courage to address those risks early before they damage our economy. In addition, the FDIC has created the new Division of Depositor and Consumer Protection to sharpen our focus on consumer protection issues. This new division is led by Mark Pierce, who has worked as a state bank regulator and a consumer advocate at the Center for Responsible Lending. Mark, where are you? He's here with me today. He's well known by all of you. In establishing this division, we are acting on our long-standing belief that consumer protection and safe and sound banking are really two sides of the same coin. Consumer protection does not take a backseat at the FDIC. While the FDIC does not have rulemaking authority for unfair or deceptive acts or practices and other consumer laws, we do have examination and enforcement authority, which we aggressively pursue on a case-by-case basis. For instance, since 2008, our enforcement actions involving UDAP violations resulted in more than $180 million in penalties and restitution. Over the past 10 years, we have taken over 1,500 formal and informal enforcement actions and have required more than 900 institutions to make restitution to consumers. In addition, the FDIC uses public advocacy and the rulemaking comment process to raise alarms about consumer protection problems that affect both consumers and the economy as a whole. We were early advocates for stronger underwriting standards for non-traditional and subprime mortgage products. We argued vigorously for banning yield spread premiums, cracking down on prepayment penalties, and requiring full income documentation and underwriting based on the fully indexed rate. We have also consistently advocated for stronger rules and regulatory guidance to address misuse of fee-based overdraft protection. I believe overall that the vast majority of community banks which the FDIC oversees have a good record on consumer protection. The success of their high-touch business model depends on it. Yet, fee-based overdraft protection is one area where we have seen large increases in consumer complaints. The FDIC's 2008 study of bank overdraft protection programs found that a small number of consumers bear a disproportionate burden of overdraft fees. We found that while only 5% of bank customers had 20 or more overdrafts per year, this group accounted for nearly 70% of all overdraft fees. On average, these customers were charged more than $1,600 per year in overdraft fees. Amendments to Regulation E by the Federal Reserve that went into effect this summer addresses many aspects of this problem. The amendments prohibit banks from charging overdraft fees on ATM and one-time debit card transactions unless the consumer specifically opts in to the overdraft service for these types of transactions. Also, the Truth in Savings Act will now require banks to show the dollar amounts charged for overdrafts and non-sufficient funds, or NSF fees, on consumers' account statements. Last week, the FDIC issued overdraft guidance for the banks we supervise that established our expectations for them to actively monitor the use of automated overdrafts and to limit overdraft use by customers as a form of short-term, high-cost credit. Institutions are expected to contact customers who overdraft their accounts more than 6 times in a 12-month period and to discuss with them less costly alternatives such as linked savings accounts, a more recently priced line of credit, or a safe and affordable small dollar loan. The guidelines recommend that banks allow consumers to affirmatively choose the overdraft payment product that best suits their needs. They also call for daily limits on overdraft fees and an end to practices that are simply geared towards maximizing fees, such as clearing the largest checks first. These guidelines are a common-sense approach that can help mitigate risks to both consumers and banks. One important lesson from the mortgage crisis is that selling consumer products that do not serve them well ends up hurting both consumers and banks and weakening public confidence in the financial system as a whole. The adverse impact of overdraft fees is especially acute for low-income consumers. Our 2008 study showed that low-income consumers earning $30,000 or less were twice as likely as upper-income consumers to incur 20 or more overdrafts a year. Addressing issues that deeply affect lower-income and underserved consumers is a priority at the FDIC. That's why in 2006, I created the Advisory Committee on Economic inclusion, comprised of individuals from banking, academia, government, and consumer and philanthropic groups, to advise the FDIC on how to make the financial system more accessible to more than 25% of the population that is unbanked or underbanked. One of the initial projects recommended by the committee, the Small Dollar Loan Pilot Program, recently wrapped up after 2 years. This pilot demonstrated that banks can offer safe, affordable small dollar loans as an alternative to high-priced sources of emergency credit like payday loans or misuse of fee-based overdrafts. We are now conducting a year-long case study at 9 volunteer banks to evaluate how they can offer safe, low-cost transactional and savings accounts that are responsive to the needs of underserved consumers. These checkless accounts are largely electronic, and they strongly encourage automatic savings. Most importantly, there are no overdraft or NSF fees. We are hopeful that the findings of this case study will encourage more institutions to offer safe and low-cost accounts for underserved consumers. One of the most urgent consumer protection issues that we see now involves serious weaknesses in mortgage servicing and foreclosure practices that have come to be associated with the practice of robo-signing. Some mortgage servicers have failed to properly assemble the paperwork needed to establish ownership of mortgages and the right to foreclose on delinquent loans. And some have pursued foreclosures and loan modifications in an uncoordinated dual-track process. This has often led to needless confusion for borrowers and can result in costly and unnecessary foreclosures. These mortgage servicing weaknesses are a byproduct of both rapid growth in the number of problem loans and a compensation structure for servicers that is not well designed to support loss mitigation measures. In my testimony before the Senate Banking Committee earlier this week, I outlined what I see as steps that mortgage servicers can and should